He owned millions of acres of Chinese forest. Nobody had ever gone to check. In June 2011, a research firm called Muddy Waters published a report about a Canadian-listed Chinese forestry company called Sinoforest Corporation. The report was titled simply, "We believe it is a multi-billion-dollar fraud." Sinoforest stock, which had been trading at around $18 on the Toronto Stock Exchange, fell 74% in 3 days. Within weeks, trading was halted entirely. The company that had claimed to own and manage millions of acres of productive forest across China, a company that had raised billions from institutional investors and had a market capitalization of over $6 billion, collapsed. Its founder Alan Chan resigned and eventually fled to Hong Kong. He has never been extradited. This is the story of the forest that existed on paper and the man who found it by going to look. To understand the Sinoforest fraud, you need to understand the specific conditions that made it possible, and why those conditions existed in China in the early 2000s in a way that they existed almost nowhere else. Alan Chan was born in Hong Kong and built his early career in real estate and finance. In the 1990s, he identified what appeared to be a genuine business opportunity in China's forestry sector. China had significant demand for timber as its construction boom accelerated, and the Chinese government had been encouraging private investment in plantation forestry as a way to address deforestation and meet growing wood demand. The intersection of government support, growing demand, and a sector that required long-term capital investment that state-owned enterprises were reluctant to provide seemed to offer real potential for a well-run private company. Sinoforest was incorporated in the early 1990s and listed on the Toronto Stock Exchange in 1994, making it one of the earliest Chinese companies to access North American capital markets. It presented investors with a story about acquiring rights to large tracts of plantation forest in Chinese provinces, managing those forests, harvesting timber, and selling it to Chinese buyers. The revenues and profits it reported grew steadily through the late 1990s and 2000s, and the company raised multiple rounds of capital from institutional investors in Canada and internationally who were attracted to the combination of China growth exposure and a seemingly tangible, understandable underlying asset, trees. The opacity that made Sinoforest's fraud sustainable was structural and specific to its industry and geography. Verifying timber ownership in rural China in the early 2000s required physical access to remote provincial areas, fluency in Mandarin and local dialects, familiarity with China's complex system of forestry use rights, which were different from outright land ownership, and relationships with local forestry bureau officials who controlled the documentation systems. None of these were capabilities that Canadian or international institutional investors, or the analysts who covered the stock, possessed or could easily acquire. The due diligence that a sophisticated investor might readily perform on a company owning factories or commercial real estate in a major city was essentially impossible to perform on a company claiming to own forests scattered across multiple Chinese provinces. Chan understood this opacity completely and built Sinoforest's structure to exploit it. The company's transactions were conducted through a complex network of intermediaries, authorized intermediary companies, or AIs, that served as the entities that actually interacted with Chinese forestry bureaus and local sellers. Sinoforest itself claimed to purchase forest rights from these AIs, which then sold the timber on Sinoforest's behalf. This structure created multiple layers between the company's public financial statements and any underlying physical reality that could be independently verified. The AIs were entities whose ownership, relationships, and activities were opaque to outside investigators. And, crucially, Chan could claim that the complexity was simply a necessary feature of doing business in China's regulatory environment, rather than evidence of fraud. It was a structure perfectly designed for the purpose it served. The specific mechanics of how Sinoforest's fraud operated were, investigators and the Ontario Securities Commission eventually concluded, built around the systematic fabrication or inflation of the forestry assets the company claimed to own and the revenues it claimed to generate from them. The authorized intermediary structure was the key tool. When Sinoforest reported that it had acquired rights to a tract of forest in, say, Yunnan or Hunan province, the transaction would appear in the company's books as a genuine purchase from an AI at a recorded price. The AI would appear to hold documentation of the forest rights from local forestry bureaus. But the documentation was either falsified, reflected rights of far lesser value than recorded, or described land whose timber volumes were a fraction of what Sinoforest reported. The revenue side of the fraud followed a related pattern. When Sinoforest reported selling timber, those sales also passed through AI entities whose relationships with actual buyers in China were difficult to verify independently. Investigators found evidence that some of the reported revenue transactions involved the same cash moving in circular patterns between related entities, sales that appeared in the financial statements as arm's-length commercial transactions were. In some cases, transactions between entities that had undisclosed connections to Sinoforest or to individuals associated with the company. The auditors who reviewed Sinoforest's financial statements over the years, Ernst & Young Canada, faced the same fundamental verification challenge that confronted all outside analysts. The underlying assets and revenues were located in a jurisdiction where the normal tools of financial auditing were extremely difficult to apply. Auditors could review the documents that Sinoforest's management provided. They could seek confirmations from the artificial intelligence entities that were supposed to hold the forest rights. They could review the reported transaction flows in the financial systems. What they could not easily do was physically verify the forests themselves or independently confirm with Chinese government records the existence and value of the rights Sinoforest claimed to hold. The fraud was structured to exploit exactly these audit limitations. What Muddy Waters did, that auditors had not done, was simple in conception and extraordinarily difficult in execution. Carson Block and his team traveled to China. They visited the areas where Sinoforest claimed to have significant forest holdings. They cross-referenced the company's reported timber volumes with publicly available Chinese government forestry data. They analyzed the reported transaction flows through the artificial intelligence structure and identified inconsistencies between what Sinoforest was claiming and what Chinese government records showed. They found, in multiple cases, evidence that the forests Sinoforest claimed to own either did not exist in the volumes reported or were encumbered by rights and restrictions that made them far less valuable than reported. And they put all of this in an 89-page report that was published in June 2011 and immediately began destroying $6 billion of market capitalization. The response from Sinoforest management was denial, swift, detailed, and ultimately unconvincing. Chan commissioned an independent review. He appeared publicly confident, but the more sophisticated investors, who had read the Muddy Waters report, had already concluded that the questions it raised could not be easily answered, and that the structure of the company made definitive answers impossible to obtain. Here is what makes this case unlike anything else we have covered. The fraud did not collapse because regulators investigated. It did not collapse because auditors found something. It collapsed because one man got on a plane and went to look at the trees. Stay with me. Carson Block was not a typical financial analyst when he founded Muddy Waters Research. He had studied law, worked briefly in real estate in China, and developed a deep familiarity with the specific ways in which Chinese companies listed on North American exchanges could misrepresent their operations to investors who lacked the local knowledge to verify what they were being told. The name Muddy Waters was a reference to a Chinese proverb. Muddy water makes it easy to catch fish, and it captured exactly the approach that Block had developed. Identify situations where information opacity was being exploited by management to deceive investors. Do the on-the-ground verification that institutional investors and analysts were not doing, and publish the findings publicly in short seller reports that would move markets. Sinoforest was not Muddy Waters' first target, but it was by far its most significant. The report that Block and his team published in June 2011 was the product of months of work that included not only the site visits to Chinese provinces, but extensive analysis of Chinese government forestry data, examination of the AI entity's corporate registrations in China, comparison of Sinoforest's reported transaction volumes against Chinese industry data that implied the volumes were impossible, and interviews with industry participants in China who were familiar with the forestry sector. The report ran to multiple pages and made specific, documented allegations. Not vague claims of wrongdoing, but precise assertions about specific transactions, specific assets, and specific discrepancies between Sinoforest's filings and verifiable Chinese government records. The market reaction was immediate and devastating. Within hours of the report's publication, Sinoforest's stock began falling. Within 3 days, it had lost nearly 3/4 of its value. Prominent investors who had held large positions in Sinoforest, including the hedge fund managed by John Paulson, who had become famous for his bets against the U.S. housing market in 2008, disclosed enormous losses and sold their remaining positions. The spectacle of a sophisticated investor of Paulson's reputation and track record being caught by a fraud that a small research firm had uncovered in months added to the sense that the institutional investment community had profoundly failed in its analysis of Chinese companies listed on Western exchanges. The Ontario Securities Commission launched a formal investigation. Trading in Sinoforest shares was eventually halted by Canadian regulators in August 2011. Alan Chan resigned as chairman and CEO in August 2011. The company attempted to continue operating under new management while the investigation proceeded, but the loss of investor confidence and the inability to raise new capital made its position untenable. Sinoforest filed for creditor protection in March 2012, effectively a Canadian bankruptcy process, and its assets were eventually restructured and sold off. The investors who had believed in the forest empire lost the vast majority of their investment. The bondholders who had lent Sinoforest money recovered cents on the dollar through the restructuring process. And the forests that had appeared in the company's financial statements, in the volumes and at the values that had sustained $6 billion of market capitalization, were never found in the quantities that had been claimed. The legal and regulatory aftermath of the Sinoforest collapse played out across multiple jurisdictions over several years and produced outcomes that reflected both the genuine difficulty of prosecuting cross-border fraud and the limits of Canadian and international regulatory reach over individuals who had relocated to jurisdictions with no extradition arrangements. The Ontario Securities Commission conducted a lengthy investigation and in 2012 issued fraud allegations against Alan Chan and 4 other former Sinoforest executives. The OSC's case worked through the Canadian regulatory process over years, ultimately resulting in findings of fraud and market manipulation against Chan and the others. Chan, operating from Hong Kong, contested the proceedings, but was ultimately found to have engaged in conduct that amounted to fraud against Sinoforest investors. The practical consequence of Chan's presence in Hong Kong was that Canadian regulatory sanctions, bans from serving as an officer or director of any Canadian reporting issuer, administrative penalties, could be imposed, but not enforced against him personally in any meaningful way. Canada and Hong Kong do not have an extradition arrangement that would have allowed Canadian criminal authorities to compel his return to face criminal charges in the OSC's administrative proceedings, while establishing findings of fraud, did not result in criminal prosecution. Chan remained in Hong Kong, effectively beyond the practical reach of Canadian justice, in a situation structurally similar to that of Joe Low in relation to Malaysian and American authorities, geography as the final defense. Carson Block and Muddy Waters became, in the aftermath of the Sinoforest report, the most prominent short-selling research firm in the world. The success of the Sinoforest report demonstrated that on-the-ground due diligence in China could expose frauds that conventional financial analysis could not detect, and it attracted both enormous attention and significant controversy. Short sellers who publish negative research about companies they have bet against occupy a contested space in financial markets. Their incentives to identify real fraud and their incentives to drive down prices are not always easily separated. And Muddy Waters was not immune to criticism that some of its later reports were less well-founded than its Sinoforest work. But the Sinoforest case itself stands as a legitimate and consequential act of financial investigative journalism, a case where one firm did the work that regulators, auditors, and institutional investors had collectively failed to do. The broader impact of the Sinoforest collapse and the wave of similar Chinese reverse merger and listed company frauds that Muddy Waters and other short sellers exposed in the same period was a significant tightening of regulatory scrutiny of Chinese companies listed on North American exchanges. The SEC increased its oversight of Chinese auditors, limited the ability of Chinese audit firms to withhold documents from American regulators, and delisted multiple Chinese companies for non-compliance with audit requirements. The episode also contributed to the development of the Holding Foreign Companies Accountable Act, signed into law in the United States in 2020, which required foreign companies listed on American exchanges to submit to paid audit inspections or face delisting. The forest that wasn't there had consequences that stretched far beyond the investors who lost their money in it. Before we finish, drop one word in the comments. Carson Block shorted the stock before publishing the report, meaning he made money when it collapsed. Does that make what he did right, wrong, or somewhere in between? One word: hero, profiteer, or both. I read every single one. Some frauds are found by regulators, some by journalists. This one was found by someone willing to go look. The next case we're covering, nobody went to look for 30 years. Subscribe.